In this video, you will learn everything you need to know to master confirmation trading using the supply and demand zone trading methodology. Confirmation trading is a method of waiting for price action first to validate the trade before we enter, reducing the chances of false setups. Instead of blindly placing orders at supply and demand zones, we look for strong signals like trendline breaks, candlestick patterns, and much more. This is the strategy myself and many of the members have been using for many years now to trade profitably in the financial markets. In the course, we'll be going over the core concepts of what a supply and demand zone is, why it's important, the concepts of it, and then here we have all of our confirmation signals, which we'll be breaking down in full. We have our multiple time frame analysis, which is really the in-depth core concept of what confirmation trading is, and then we have our step-by-step plan, trading sequences to trade, and pros and cons as well. So let's get right into it. So what is a supply and demand zone? There is a huge difference between supply and demand and then a supply and demand zone, which I'm going to be breaking down before we get into the confirmation model. So typically supply and demand zones are price areas where the market has historically shown strong buying or strong selling pressure. And when I say strong, guys, I am referring to this explosive move up for demand, and I'm referring to this explosive move down for supply. These zones represents areas where institutions and big players have placed large orders, causing these sharp reversals and strong movements. If you just think about this logically, I wish I had a trading account that could move a Forex market that big. I wish I had a trading account that could move the market that big when I buy or sell. The reality is myself and every person listening to this video or watching this video, they don't have the power, the buying power to make price shoot off like this for a demand zone or shoot off like that for a supply zone. So what this essentially is, it's footprints on the price chart for the big players, the big institutions where they are buying and selling. A supply zone is an area where selling pressure exceeds buying. Obviously here, yes, there was a little hesitation, which is basically our basing for the zone, and then price dropped, meaning that sellers obviously exhausted the buyers. But who can do that? Again, going back to the core concept of the idea is that it is a large institution. A demand zone, obviously it's just the opposite, where buying pressure exceeds, right? We had our pause in the market and then a massive rally. This was not Joe Schmo placing a buy order and then all of a sudden price went up because there was no sellers. This was many orders shooting price up, and that is basically the core concept of supply and demand. And I'm going to go over to a price chart now to explain to you guys, not every high and low is going to be a zone. Let me explain. So everybody typically wants to come over to a chart and they see every high and every low, and they think that's a supply and demand zone. So they'll come up here and they'll draw their supply up here like this, and then they'll draw their demand down here. Why? Because, well, if you look, you can see we had a clear pivot point, low, and then we pushed up, and then, oh, there's another demand zone down here. Now, obviously, I don't agree with this. I don't know if you can hear my sarcasm, but just because price went to a price point and then dropped, or went down and then rallied, it does not mean that we have a zone. What I see here, if I was going to sit here and draw this area of supply, what I would do is I would draw it like this. Let me just get a different color out for you guys. I would simply draw the zone like this. Why? Because we have our basing, our pause in the market, followed by that explosive move down in price. Now, yeah, you could technically draw it up here, but that's just not how we do things. We are trying to wrap our lines for our zone around the basing right before the move down. And that is why this down here is not demand either. Sure, we have a drop, a base, and a rally. Technically, yes, I agree logically that demand was down here, and that is why price pushed up. That's an objective thought. It's not even my subjective opinion. However, there is no zone here. That's what I'm trying to explain to you guys. There's a difference between a zone and just basic supply and demand. Every candle represents supply and demand, but I am looking for a specific basing before that move down. And if you see for demand here, Yes, there's basing, but where's that explosive move, right? It's pretty much non-existent. If we continue to go up, there's really nothing here as far as explosive moves. I do see a little explosive move here, a single candle pause in the market before a rally up. Very, very strong trading setup, a single candle basing. But as we go up, you can see more and more explosive candles, right? We have our basing, our pause, and that massive push up. You can see we had a beautiful trading setup up here as well. If you draw the zone like this, right here, basing, explosive move up. And that is the difference. We're not just mapping out, any high or low. We're not just seeing this high up here and we're saying, oh, well, there's supply up here, right? Okay, it technically worked in this situation, but essentially we are looking again for that very, very specific basing and then the explosive move away. Looking a little deeper into understanding a supply and demand zone and why it is one of the most objective trading strategies out there is this. Let's say down here, there was 100,000 buy orders at this price level. Let's say it's $5 a share. Let's just say it's a stock to make everything really, really simple. So at $5 a share, there's 100,000 buy orders. And it's probably going to be more, right? I'm just using very, very simple numbers. So 100,000 buy orders priced pushed up from this level so aggressively that we can pretty much comfortably say it's very possible that only, let's just say, just for the sake of the video, for an example, only 80,000 of that 100,000 were filled at this area, leaving us with 20,000 buy orders left. So the concept, the whole idea, the core concept of supply and demand trading is as price returns to this area, the leftover buy orders will be triggered, causing another move up. It obviously doesn't always work like this. If it did, I would be a multi-billionaire. We do take losses. It's just, this is the core concept of a zone. Sometimes price will push down, maybe fill in the rest of those buy orders, the 20,000, but then price will push lower and break the zone because maybe the banks want to buy somewhere down below even more. So that is the core concept of what a supply and demand zone really is and why we purchase the zone on the return, or why we sell the zone on the return to supply. If you want a more detailed video on that, see my full supply and demand course breakdown on my YouTube channel after this video. But that is the core concept, and that is why supply and demand trading gives me so much confidence, and it just boosts basically my whole positive outlook on trading, due to the fact that, in my opinion, we are trading with the large players with this objective reality here where price shoots up objectively, meaning there are most likely some leftover buy orders sitting down below. And let's say there's not leftover buy orders sitting down below. Well, if the banks bought here before, doesn't it make sense that they would buy here again? Right? Even if you don't believe the whole order thing, that's completely reasonable. But if the banks have bought in here before, it's most likely they're going to be buying there again. The big question is, how big of a move are we going to get from that zone again? And that goes into more detail, but this is just the core concept, of what a supply and demand zone is. And hopefully this explanation, gives you guys a little bit of more confidence. Let me know in the comments down below. All right, so the big question, why should we confirm our entry? Why does confirmation truly matter? Well, because blindly entering at a supply or demand zone, it can definitely lead to an unnecessary loss, and confirmation will help filter weak setups and increase the probability of a successful trade. There's many more pros and cons, so make sure you stay tuned for that at the end of the slide. And I'll be fully honest with you guys, confirmation trading is not the only entry model that I use. I also use the set and forget entry model as well, which I'll be doing a full course on some point in the future on my channel. So make sure to subscribe for that in the future, and I would appreciate a like on the video if you're enjoying the video so far. So blindly entering at supply and demand zones can lead to unnecessary losses. So what do we do? Well, let me show you a great example over here on the USD JPY chart. This is a 15-minute time frame. And on the 15-minute time frame, we identified this explosive move to the upside, right? So we are simply going to wrap our lines around the zone. Right there, we have our two parts of a zone, the basing and that explosive move. This is objectively a demand zone because price shot up from this price area. And, objectively, only a large player is going to make a move like that. So price pulled down. We almost contacted the zone, but we were patient and we waited for the zone to actually be hit. And you can see we pretty much blasted right to the zone before we ended up taking off. So if we go down to a lower time frame, this is a 15-minute time frame. The entry time frame for a 15-minute is the 1 minute. We'll be breaking down the time frames later on in the video. So as price pulled back into our zone, remember, this is our higher time frame area of demand. This is the 15-minute demand zone. Now all these candles represent the 1 minute chart. I know you guys probably understand that. I'm just breaking it down. So typically for supply and demand zone trading, we are waiting for confirmation, which means basically this. We're waiting for price to come down into our zone, base out, and basically create that explosive demand zone. The same thing we were just looking at on our 15-minute time frame is what we are looking for on our entry time frame. So we were looking here, we were waiting for price to basically do that, to basically base out and explode to the upside, giving us our demand zone. But if you look, we didn't get that. Price completely shot down. We based up here, creating a couple little small areas of selling or supply, and then we just blasted through the zone, and we ended up shooting up. This confirmation here would have prevented you from taking a loss on this trade. Now, obviously, price could have taken off without you, and you would have missed the trade. That's why I'll be going over the pros and cons, and it's not all pros. Again, this is not the holy grail, so don't expect that. You will still take losses, whether you're looking for confirmation or not. But in this example, we waited for confirmation, and we just simply did not get it. So as price pulls into our higher time frame demand zone, we are essentially waiting for opposing zones to be clear. We are waiting for those zones to be removed. If there's a strong supply and demand zone nearby, price could reject off of that supply or demand zone before reaching our target. So that is why we want to wait for basically for the zones to be removed for our confirmation. So going back to this example here, we blasted through the zone, but on the way down, I pretty much identified this area as the main area of supply that I would have wanted to see removed. So I would have wanted price to come in here, obviously not break it, and then come into the zone, push up, break this area of supply, hopefully leaving us with an area of demand down below to look for a buying opportunity. And that demand zone, again, that demand zone is going to, on our entry time frame, is going to look pretty much the exact same on our entry time frame. Okay, so we're essentially, all time frames are fractal. So what we are looking for on our higher time frame is the same thing we are looking for our entry time frame. We're looking for that basing and that explosive move away. Now we also have our trend line resistance. If price is pulling back with a strong opposing trend line, it could push against our trade. So you could literally get an entry, right? A good area of demand, you bought it, and then price pulls up to a trend line and then reacts off of it, and then we break the zone. It is a possibility. So when we have a downward trend line, right, that indicates weakness, and when it's removed, that indicates strength. It's very, very simple. But just because we remove a trend line doesn't mean we have a zone. In this instance, we did. We have a clear zone here that broke this downward trend line. So let's say here we have our downward trend line from up here, something like this. You can see this downward trend line was clearly removed, and right away my eyes as a trained supply and demand trader are going to this single candle basing before that explosive move away. Notice how I didn't just go, like I was saying earlier, I didn't just go right to the bottom here and just draw the demand at the bottom. Why didn't I do that? Because look at the difference here, right? We're going to break it down right now. Look at the difference. Hopefully you guys can see. Not explosive move away, explosive move away. Now, if this zone was all the way down here, then obviously I would draw it, but that's not the zone. This is the zone that broke the trend line before price pushed up. And again, let's say our zone was down here and we didn't break the trend line. We could literally take an entry at our zone. It could hit our trend line, push down, and stop us out. My trend lines are pretty accurate. Feel free to watch my weekly Forex forecast on YouTube every week, and you'll see the accuracy of the trend lines and the zones. So that's why I love when we get trend line confirmation like that, because the trend line a lot of the times will actually work against your trading setup. But again, notice explosive move away, non-explosive move away. And that is what we are looking for. And confirmation, it just boosts confidence. Now, again, I'll be going over the pros and cons of it all. It's not all pros, so don't get it twisted, but it definitely removes doubt by giving clear signals, right? It gives us signals that institutions are stepping in when we see those explosive moves, and it also helps overcome hesitation. Hesitation is not an account killer, because obviously you're not taking trades, but hesitation can definitely be a huge problem. And when price pulls into our zone and in a downward trend, let's say none of this happened, it's not looking too great, right? You're basically, you're trading with an entry time frame downward trend, and the trend line could really go against you. But when we see that explosive move to the upside, if you just think about the logic behind the supply and demand zone that I trade earlier, now you can think, hey, large players are stepping up here, guys. We have a massive push up. To me, that indicates banks or institutions buying. So look, I think I want to buy at that pullback, and a lot of times it will work out, and sometimes it won't. Maybe the banks have a different idea than what you did, but at least we're trading with the banks with these explosive moves, and we're not trading with retail with these little baby moves. I know that obviously the banks are creating everything and retail is just trading inside of it, but again, we're looking for price points where buyers exceeded sellers, or for where sellers exceeded buyers. So when taking a confirmation trade, there are two main steps. Number one, we are simply just going to wait for our higher time frame supply and demand zone to be contacted. So let's go over to a price chart here, and I'll show you guys exactly what I'm looking at. So this is a daily time frame. For example, we will be using the daily as our higher time frame and the H1 as our entry time frame. Now again, stay tuned for the time frame combinations to use later on in the video. So I identified this demand zone down below. I knew I drew it bigger. This was drawn beforehand. This was an actual trade that we took as a group here on the Aussie US dollar. Here you can see from my weekly Forex forecast on YouTube, it's the exact way I drew it on my YouTube video, and it's the exact way I'm drawing it here. So I'm not just drawing it bigger for the sake of the trade working out. I actually did it beforehand like that with video evidence. So we simply had our daily area of demand down below, and we are waiting for that demand zone to be contacted. If you look here, the zone was not contacted right here, but the zone was contacted right here. And then that, to me and to everybody trading confirmation, that is going to be our signal. And what is that our signal to do? That is our signal to do number two for the main two steps when trading confirmation. Number two is simply dropping down to our entry time frame, and then we wait for our confirmation signal. We are confirming our entry on our entry time frame inside or near a higher time frame area of supply or demand. So if we go over to our price chart here again, we waited for our demand zone to be hit on our higher time frame, which is the daily. We then went down to an H1 time frame, as you can see here, and we got a confirmation signal down below. We had a downward trend line right there. That downward trend line was removed. If you look, again, higher time frame zone contacted right here. And then if you look, what do you notice? Do you guys notice an explosive move away here? No, we don't. And if you notice, if you try to draw a zone here, we blasted right through. However, when we draw our confirmation zone down below right here, why is that a zone? Again, going back to the core concept of supply and demand, we have our basing and that explosive move away. And then that trend line broke. So what this meant was that, hey, this downward trend, that's over. And not only was the downward trend over, it was over with this demand zone breaking it. Now, if price just looked like this down here, there would be no trade for me. But as you can see, price pulled back beautifully into our entry time frame demand zone, and we got a beautiful trading setup off of that zone. And this was called out beforehand in the daily market breakdown video for the diamond members beforehand. I don't just post trades with no video evidence. All the trades that I post, we have video evidence showing us that we actually took this trade. So this is the core concept of what confirmation trading is. Again, we waited for our higher time frame zone to be hit, and then we waited for a demand zone on the lower time frame to be formed, and we simply waited for the pullback down to that area of demand. Now, like I said earlier, we are waiting for this zone on our entry time frame to be formed at or near our zone. So if this zone, for example, let's say it took place up here, that would also be fine. If it took place a little bit higher, that would also be fine. I do prefer the confirmation to be at the zone. That is just preferred. And another quick tip, let's say this confirmation happened even lower. Instead of putting our stop loss below our entry time frame zone, you might, since it's lower and your risk reward will still be better, you could just tuck it underneath the higher time frame zone, give you that extra support. But up here in this instance, my stop wouldn't be all the way down below here. That would just be too big. You can do that. It would just, you're basically just taking the entire higher time frame zone at that point. So that's why the stop would just be underneath the zone, obviously giving us a nice trading setup. So again, I do prefer the confirmation to take place at the zone or like near the zone. My preferred distance from the zone, if I'm going to trade outside the higher time frame, is like right here. When you start to get trades up here after price contacted our higher time frame zone, this isn't really confirmation anymore. It's still good because at least you're trading with an entry time frame zone up here after price contacted our higher time frame zone. It's just not really confirmation at that point. Confirmation to me is when price is near our higher time frame zone and then we get the zone. So I do prefer, again, the confirmation. This is like the perfect spot for the confirmation right here, right at the tip of the zone, either there or lower or even mid, right? But again, as we start to push out, if we get the confirmation up here, it's not really confirmation anymore. It just means that our higher time frame zone is in control, which is still great, but it's not, confirmation like we are seeing it here. All right, now we're going to dive deep into all the types of confirmation signals. The first one we will be talking about is easily the most common one, is a zone removal. So let's say you are looking to buy at demand. We are waiting for supply zones to be removed. If you're looking to short at supply, we are looking for demand zones to be removed. It's just the opposite. And when we get the zone removal, that confirms that the previous buyers or sellers, that they've been overpowered. Looking at this chart here, this is our supply zone and this is our demand zone confirmation. This supply zone, again, we have that explosive move down, proving to us that there's supply there. There were sellers up here. And then when price broke through that supply, that shows us that the previous buyers or sellers, that they've been overpowered now, meaning demand is now in charge. Demand is now the man. It almost sounds like the man. Demand is now the man, right? So that is now what's in control. That's how I kind of view that there. And this reduces the chance of reversal. If we were to we have it at what looks like a demand zone here, a nice explosive move, but price holds the zone, probably end up going to break in that zone. That's basically what's going to happen because the sellers took control and they're proving to us that they are in control still. So this break creates fresh supply or demand usually, and it'll give us a pretty high probability area to enter a trade with confidence. So going over obviously to a real price chart, because everybody loves real examples, you can see we have a blank chart. But what I noticed right here, which I hope everybody noticed as well, is you can see we have that explosive move away right there. So we simply draw our demand zone, something like that. You can see we got a beautiful trading setup off of that zone. But why was this a confirmation zone? Well, let's say our higher time frame came in control right down here. We were patient. We did step one. We waited for our higher time frame to be contacted, which it was. And then once it was, we identified our opposing supply zone right here. It's a little hidden base drop area of supply. Let me just go ahead and we can make that red just for the sake of the video. So we have our opposing area of supply. Not the best supply zone I've ever seen, but it is a somewhat explosive move down. This explosive move away is much better, just so we're clear. So basically, we waited for sellers to be exhausted by removing the supply, and then we simply placed our order at the zone, waited for a return with our stop loss down below and our take profit above. And I mean, this was a picture perfect trading setup. Now, a lot of you might be asking, Kevin, well, why wasn't this a zone then? And I agree with you that if you look, there was a clear area of demand here because price pushed up and created another explosive move just like we did here. But this trade failed. And why? Well, in my opinion, because this was the original zone over here, and this was simply just a reaction. So a lot of the time, just a bonus tip, a lot of the times when you see a zone like this that looks amazing and it was removed like pretty easily, usually this is going to be why. This is why I do my chain analysis, which is identifying every zone that removes every zone and trying to trade the most original zone. And in my opinion, this was the original zone, and this zone here was just simply basically we were already in the trade at the zone from this zone, and then anybody buying this zone, they already kind of missed the trade. And I will see this zone work sometimes, but I usually don't like to trade a zone that's pretty much a reaction off of a previous area of demand. So again, we waited for a higher time frame to be contacted, and then we waited for an opposing zone to be removed with an explosive candle. If this zone was removed and all of this was just a bunch of basing candles, then there would be no trade. We still need that explosive move. The second type of confirmation is when we get a trend line removal. This occurs when price breaks through an opposing trend line. This signals a shift in momentum way more than just an opposing supply or demand zone removed. This removal shows that the market is ready to move in the direction that our higher time frame zone is in. Obviously, if we are buying, we are looking for price to turn around and start to go up. And removing a downward trend line, well, obviously that's going to be a decent amount of evidence to suggest a pullback entry could be a good buying opportunity. And the trend line confirmation, it's the strongest confirmation signal that we can get. Again, just based off of the fact that we are removing an entire trend. It's not just some random line, it's not just a zone, it's an entire trend, and we are changing directions on that trend. We're not just blindly buying in a downtrend. We're waiting for that trend to be removed, hopefully leaving us with that demand zone down below that removed the trend line. And the absolute best, my favorite confirmation signal is when we get both an opposing trend line and an opposing zone removed. So in this example on the chart here, you can see our downward trend line. And our downward trend line was removed by this demand, explosive move away. But you can also see we had a supply zone right here as well. You can see it's a supply zone because we have our basing and that explosive move down. So that is why that would be a supply zone. You can see we almost got a reaction off of it as well. And so in this instance, this was a great trade for two reasons, because we removed a trend line and we removed an opposing supply. I just didn't draw it on the chart because I was trying to just show you guys a trend line removal. But a lot of the times we will get both. Not all the time, but a lot of times we will. You can see over here, this is a great example of when we only got the one. So you can see we had our higher time frame come into control. We were patient. We waited for the higher time frame to be hit. We didn't just look for confirmation up here or here. We literally waited for the zone to be hit. Now, there are times where price may come down and do something like this. And if you really zoom in, okay, maybe it wasn't hit. So if I just show you guys here like this, let's just move this zone down. Let's say price did this, and then when you really so it looks like it hit it, but when you really zoom in, okay, it didn't. In that instance, I think it's fine, as long as it's not just somewhere down here. It's pretty reasonable. Obviously, you guys can kind of make a judgment, but we waited for a higher time frame zone to be hit, right? And then we have our downward trend line right here. And notice how this is a very obvious downward trend line, right? Clear valleys and peaks and lower lows. It's very obvious. Everybody on earth, as long as they know what a trend line is and they've looked at a chart before, they will be identifying that downward trend line. That is very important as well. We're not just looking for, momentum like this. So this, to me, that would be like momentum, or that would be momentum. We're not looking for that. We are looking for very clear and obvious trend lines. If your trend line isn't super obvious, like, wow, everybody's going to see this peak and valley and that lower low and this trend line, then you're on the right track. That is the type of trend line we are going to be looking for. And in this instance, we actually don't really have any supply here that I'd want to see removed as well. So in this instance, when price was pulling back into our higher time frame zone, as soon as our zone was hit, we are understanding, I'm saying to myself, I'm not saying it out loud, but I'm thinking this. I'm saying, okay, we don't have any opposing supply here to be removed for confirmation, but we do have a downward trend line, and I am simply going to wait for that downward trend line to be removed for confirmation. And when we zoom in here, you can see this downward trend line came in, and we broke the downward trend line as we started to close above that downward trend line. And if you look down below, well, what do you see here? We have a very picture perfect confirmation trade right here. Let me make it black just to make things even more clear. So we have, again, our basing followed by that explosive move up. We didn't get a move up, that looked, I don't know, I'm trying to find an example. We didn't get a move up that looked like this, where it's just a bunch of basing candles. Again, going back to the core concept of what supply and demand is, we simply waited for that explosive move. And again, if there was no explosive move here, there's no trade. It's as simple as that. And then we simply just waited for our order to be triggered, stop loss below, take profit above. There's many ways to take profit and stuff. We'll probably go over that later, but I'm just saying this is the trend line removal. And like I said, it's better if we can get both a trend line removed and an opposing zone. So let's just pretend that there was a supply zone here as well, right here. Let's just say there is not. I want to make that very clear, but let's just say, let's make one up right now. So let's say there was a supply zone here as well, and we also remove that. To me, that is going to be an even better confirmation signal. Now, again, I would have taken this trade anyways, just off of the trend line. So why is it important to look for both? Well, when we have both supply removed and a downward trend line removed, that just boosts confidence in the trade. And if you journal your trades, which I highly recommend that you guys do, journaling your trades is so important especially for your trading psychology. And if you guys want tips with your trading psychology, make sure you check out the Stoic Trading Psychology podcast that I release for everybody. So check it out anywhere you get your Spotify or anywhere you get your podcast. I also have the YouTube channel as well. So check it out if you want help with your trading psychology. So just by seeing not only a trend line removed and an opposing supply removed, that's like a double whammy. That's like saying, hey, there's not going to be any selling pressure up here. There's not going to be any trend line, contacting a price as we take our trade. So I'm feeling pretty confident in that. And when you're feeling confident, that obviously is a good thing. We don't want to be going into a trade not feeling confident, because let's just say you're not confident and then you waited for this trade to trigger. Let's just say you typically look to opposing, you look to target the opposing high. So up here, that was a 2.75 to 1 trade. Well, if you weren't confident in the trading setup, you might have taken profit like right here. Just, I'm a little bit nervous, but I'm gonna take profit. And then you don't even make a 1-to-1. Where if you had confidence, you could easily hold the trade longer. You could take your 3-to-1. You could take your 4-to-1 worked out as well. So there's many ways to take profit. Again, I'm just saying, when we have that extra confidence, it just leads to better trade management as well. And then again, if you have a trading journal, you might pick up on something in your stats where you say, okay, if we have a trend line removal only, the demand zone pullback, it's great. It's a great win rate. It's profitable. But when I have both, maybe my win rate goes up 5%. And 5% is a massive, massive edge. So that's why I'm saying, try to pay attention, see if we can get both. And again, this is not a supply zone. I want to make that very clear. I'm just pretending for the sake of the example that it is a supply zone. So typically, seeing both trend line and opposing zone removed, that's my bread and butter. That's what I absolutely love to see. And typically we will have opposing zones removed here. This is just actually a rare example where we don't have any and we just have the trend line removal. But nonetheless, beautiful trading setup after that trend line was removed. Another type of confirmation signal, which is definitely not one that I only use alone, is when we get a structure shift. A structure shift occurs when price breaks an obvious high or low. So you can see on the screen right now, obvious. It has to be obvious, as in everybody is seeing this previous high here, just like everybody is seeing this previous high here. That's different than saying, oh, that's a high there or that's a high there. It needs to be obvious, meaning price needs to, for a low, come down, push up and create that obvious low, or for a high, push up and create that obvious high, just like we have for these two examples. Now, you heard me mention, I don't use this confirmation alone, and I do not. To me, this confirmation usually will also include a zone removal as well. So this, in my opinion, this is just used as an extra odds enhancer, in my opinion. So let's say we have a supply zone here and that was removed. Well, obviously it's a obvious high as well that was broken. So the way I look at this is it's just an extra confidence booster, an extra odds booster, whatever you want to call it, when judging the quality of a supply or demand zone. And the issue with using this alone is that you will get it a lot. And in this instance, we're going back to this example where we had our trend line removed and then we had our opposing zone. Well, let's just for this example, there was no opposing zone, which there was not. Our structure high that we were looking to see removed was this right here. Why this one? Well, because in my opinion, it was very, very obvious, right? It's not like we were calling this little wick here, oh, that's the structure high, we removed it. It has to be obvious. And this one, it was very, very obvious. We pushed up, we did not remove it before we created the zone. Therefore, there would be no trade if you only looked for a structure shift. Obviously, we had that trend line coming in, which gave us that demand zone setup. But in this instance, if you just looked for structure high to be removed, you simply just didn't get it. Now, let's say the structure high was down here, and then, we had our downward trend line removed, and then our opposing supply here. That's like let's say it was removed there. That's like a triple whammy. That's like three big things. That's going to give me a lot of confidence in the trading setup. If we just go over here a bit, you can see a great example of when we actually got a structure high removed. So you can see here, we had a very obvious high. Why is this the obvious high? Well, I mean, look at it. Obviously, everybody's seeing this high in price. Now, you could also go over here and say that this is a structure high as well. That's definitely a reasonable thing to say. And then we actually had a demand zone here, and that would have been a loss based off of the structure high being removed. Now, remember, this all revolves around waiting for price to contact our higher time frame demand zone. So this is only something you're going to do when price contacts our higher time frame demand zone, and then we break the structure high. So remember, we are always waiting for our higher time frame zone to be in control before looking for any of these confirmation signals. So I wanted to show you guys this loss because I like to keep things realistic here. This strategy is not 100%, right? So just letting you guys know, you will take losses. But you can see over here, we had our structure high. That structure high was clearly removed there. And if you look, we had right before it was removed, you look down, we have an explosive candle and our basing candle. So if we were to draw our zone, this is where it would be, right here. That would be our demand zone. You can make it just a little bit bigger if you want to wrap it up nice and tight. And a beautiful, picture perfect trading setup right there. And like I mentioned, often you will get a zone removed as well. And you can see we did. So that is where that's where the zone, the opposing zone, was removed. So like I also mentioned, I don't only look for a structure shift confirmation. When I look for confirmation, I am looking for either one, a supply zone to be removed, or two, a downward trend line to be removed for buying. Obviously, it's just the reverse for supply. So in my instance, if this was me here, I would be taking this confirmation trade purely based on the fact that it removed this area of supply. And then I could see above and be like, hey, it also removed a obvious structure high. That's going to give me a lot more confidence in that trading setup. And in this instance, it would. So this is a great example of when we had a structure shift, but also an opposing supply removed. And it was a beautiful trading setup. And again, I do not recommend only looking for structure high to be removed. The only time I would really recommend that is, again, let's say our higher time frame came in control down here. Let's make it green. And then price does this. And then we have our obvious structure high, but there's no supply zone here. Let's say there's no trend line for whatever reason. There's no supply zone, no trend line, and all we have is that structure high right here. Then okay, that's an instance where any demand zone that removes that structure high could be our trading setup. But I much prefer when we get an opposing zone removed as well and a downward trend line. Now, it's very difficult to get all three. I mean, typically when we do get a downward trend line removed and an opposing supply removed, we will get some sort of structure high removed as well. But again, just letting you guys know, just a structure shift, not going to be the best trading signal. It's usually just a great confidence booster when looking for opposing zones or trend lines to be removed as well. Another type of confirmation signal, which really isn't a different signal, it's still the zone removal. This is more of a way to trade differently, to trade the confirmation a little bit differently, and that is what we call a breakout order. But again, we are still waiting for a zone to be removed. It's a simple yet effective way to trade confirmation, and there are two ways to trade this, there are two steps to trade this confirmation. First, we need to identify an opposing zone that needs to be removed. So down here, we identified our opposing zone that needed to be removed. And then our step number 2 is once price approaches it, we are looking for a zone in our direction we want to trade with. And if that zone forms, we simply place a stop order just beyond the distal line. So a stop limit order right here with our stop loss below the demand zone. And why this is different is because typically we wait for the zone to be removed, then we just simply buy the pullback, where in this instance, we are trading that breakout, and that is the difference. And this is used really well when investing long-term, which I will explain here in a bit. But let's break down on a real chart what this is going to look like. So again, step number 1, when trading confirmation, higher time frame zone and control. This is a 1 minute chart. Our higher time frame for the 1 minute, which I'm going to talk about later, is the 15-minute time frame. So here, this is a 15-minute time frame. Right here, our higher time frame zone was contacted beautifully right here. So step number 1 for the breakout trade is we need to identify opposing supply that needs to be removed. And we simply identified it right here. Why is this supply? Basing and that explosive move away. Notice how every time I'm looking for supply zones to be removed, every example I've showed you, except for the one that I made up, is we need those explosive moves for anything. I would have no interest in trading this zone because it prices at a higher time frame zone, but even the confirmation zones I want to see removed, they need to be qualified with that explosive move away. So we identified, so basically step 1, price hit our higher time frame zone. We then look up, we identify our opposing supply that needed to be removed, and the step number 2 is I need to identify the zone, right? That is going to be the zone that we would be buying a pullback to if price removes it. So in this instance, price removed the zone right there, and then we had our confirmation trade right down here. And you can see the way I drew it, we missed that trade. So typically our typical confirmation, right, the classic confirmation, zones removed, we have our new demand zone formed down below with that explosive move away, and then we're waiting for price to pull back, fill us in, and hopefully hit our take profit rather than our stop loss. In this instance, we didn't get that pullback down to that trade. So that's where the stop order comes in. So simply what we do, let's just use our risk to reward tool, is instead of placing our risk to reward tool down here like this, you right click, you can create your limit order, right? Instead of doing that, we are simply identifying the zone down below that's formed. And instead of waiting for a pullback, we are simply placing a buy stop up here, which is a breakout order, meaning when price pushes up and breaks it, we'll be filled. Right there. It's a breakout order. And where's our stop loss going to be? Not here, not here. It's going to be tucked under the zone like that. Now, and then what this did here in this situation, it actually got us in the trade rather than us missing the entry pullback. Now, you might notice the risk reward is very, very large compared to if we just simply did that. So that is the pro and con of this type of strategy, right? If you wait for a limit order, right, we could come down here, push up, and price will have a nice risk reward, and price will take off in a direction, hopefully, with a nice risk reward. But in this instance, we didn't even get a trade. However, if we did the stop order up here, okay, our risk reward is much worse now, but we made a little bit of money here in this trading setup. Now, obviously, we want price to continue to go up in our direction, and it did just that. So this would have been a very, very nice trading setup. Let's just say you were looking to target this opposing high, just for the sake of the video. If you look here, our risk reward with the breakout order is a 1.62 to 1. That's not bad, right? I have no complaints about that. But let's say we waited for price to pull back. You can see we actually wicked beautifully into the zone. I actually didn't even know that at the time of recording. I wasn't even going to go on with this, but we can go on perfectly. So that's that trade. But if we simply waited for a pullback, look at the difference in risk to reward right here. Something like this. Then we target this opposing high. That's almost a 10-to-1 trade. Now, I'm not saying I can hold all that time. I'm just trying to show you guys the difference in the two setups here. But again, price might have not have come and tapped you in here. So there's pros and cons, and you're going to have to back test everything. I'm not saying, I mean, I do prefer the pullback order just because you get a better risk reward typically. And again, this works really well when investing. Let's say this is a stock, and you really, let's say it's Apple stock, and you really want to buy the breakout of Apple. Well, instead of waiting for a pullback down to a zone, and I don't know if, when I invest, I don't have a stop loss. So the fact that my risk reward is worse doesn't really bother me. I'm going to buy pretty much the same amount of shares up here than I would down here. Obviously, when you're trading, it's going to be a little bit different. So this works really well when long-term investing without a stop loss, like on the S&P 500 or something like that. And then another option, you could simply try to trade both. So you could literally trade the breakout order with a stop loss under here, and you could risk 0.5% of your account with another order here, right? Trying to get the limit order, and then risking the rest of that 1%, the other 0.5%. And now you have two trades going in your direction. Now that's definitely a possibility. You got to definitely practice a little bit of patience, but I'm just showing you guys a different way to kind of view this and a different way to trade it. You don't have to split it up. You can literally just risk 1% on this one, looking for a 1-to-1. And I will say this strategy works really well for like 1-to-1 type entry when you're looking for like 1-to-1 risk to reward. If you're looking for a higher risk to reward, that's fine. But then, I mean, in order to get a 3-to-1, price has to go here, where if you price wanted to go there from our entry order, that's a 13-to-1. So these are the pros and cons of trading, which I will be going over later as well. But these are the pros and cons of this type of entry. And again, we still need everything to be explosive. We need an explosive supply to be removed. We need an explosive demand to be removed. We need all of it. So to recap on this, we are identifying our lower time frame supply that we need to be removed. We are identifying what appears to be a demand zone. That is where our stop goes under, and then our entry just goes above the distal line of our supply zone here, and we are simply trading the breakout. All right, so I wanted to show you guys a real example of a real confirmation trade that we took inside of the membership. So it all started with our higher time frame, which in this instance is the H4 time frame. With the H4 time frame, we are going to be looking for entries typically on a 15-minute time frame. You can also look for entries on a 5-minute time frame if you don't see anything on a 15, but typically we want to be on the 50-minute time frame in order to be looking for trades when our H4 is our higher time frame supply or demand. So importantly, our higher time frame supply was a good zone as well. Not only was the basing decent, we had a very aggressive, very nice explosive move away. And not only that, we removed a opposing demand zone with that area of supply. You can see we got a beautiful trade off of this supply zone. This was a setup on its own, and I called this zone out before anyways, but that was a setup on its own. We also looked for a confirmation trade, which is what we looked for during the daily market breakdown video. I pointed out two zones here. We had one here, and that one ended up failing, right? We did get a small move off the zone. You actually could have even been taking profit there. Depends on how much profit you are really looking for. But we did get an initial small move off the zone before we ended up failing. And then we had the better supply zone up above. That was our better confirmation because it removed a trend line and it removed some demand as well. Well, technically this is the zone that removed the demand, but I'm not going to get into that. But it technically removed the trend line. That is why that is the better area of supply above. And not only that, nice tight basing, and just like our higher time frame zone, which is this big red box here, we have very nice explosive move down as well. And not only that, it's kind of above all this liquidity as well. So you can see we got a pullback into that trade, or into this zone. Wider stop, always good on these types of confirmation zones. Beautiful move off the zone. I mean, Me personally, I wouldn't have been able to hold for this whole kind of drawdown after that. I mean, it's not a drawdown, it was profit. It was all profit, but I couldn't have waited here and got that entire move. But if somebody did, absolutely amazing, but I couldn't have got that entire move. To me personally, that the move already happened, right? When we got the initial pullback to the zone and then we rallied here. If you look at the risk reward, this was an absolutely picture perfect setup. I mean, for risk reward as well. If you look, we targeting the lows down here, you're already at pretty much a 5-to-1. So it was a beautiful confirmation trade, 5-to-1. And again, why was this such a good zone? Because our higher time frame supply, which is this big red box, that was a very good supply zone, and we simply waited for our supply zone to be contacted, which was right here. And at that point, that was telling me and the members, which I was telling them, now we got to look for shorts on our entry time frame, which is the 15-minute time frame. And like I always tell everybody, all these trades that you guys see where I'm saying we pointed them out, I'm not going to point out a trade in a video and say this is a trade that we took unless there's actual video evidence. So if you see here, this is a Zoom session recorded on October 2nd. That's for the Diamond members. This is the daily market breakdown video. And you can see this is where I called out this trade. You can see I already had the overall 4-hour area of supply right there. And if you play the video, you'll see what I was talking about. And the Euro GBP, last but not least. So beautiful move off of this supply zone already. And we are clearly pushing down. We actually did create a confirmation trade here. So we had a demand zone removed. That demand zone was removed by this supply zone there. If you want, we really could be waiting for this area of supply to be hit as well. So that's our fresh supply zone above. It's kind of the origin of the whole move. Don't love doing that, but it's kind of a, I don't know, it's a decent zone. It's our confirmation we could see a move off that supply. Again, that was me calling out that trade before it took place. Video proof, not just some, screenshot, fake P&L or whatever. This trade actually took place. This is an actual confirmation trade that we took. And I get questions all the time from people, oh, what zone do I take? There's 2 zones. Well, this is a great example of, let's just say you didn't take profit here. Let's just say this was a loss and this was a win. Okay, well, you lost 1%, right, on this zone. Right? That's a loss, whatever. And then you still take this zone above, and then now you make a 5-to-1 trade, 4-to-1 trade. Let's just say you only got 3-to-1. 3-to-1 trade, you're up 2% now, and that's by taking both zones. If you're going to take one, I always pretty much recommend taking this one, especially if this zone's not super high quality. But I'm just saying that when our higher time frame supply is good and we're expecting to get a reaction off of it, guys, because it's a good zone, you definitely can take both zones in this situation. I don't want people thinking you got to pick a zone and which one do I pick? It does suck when there's like 4 or 5 zones on top of each other. Then at that point, it's kind of too much. You might want to start to pick the ones at the top for supply and below for demand. But just wanted to point out this real trade example, again, called out in the daily market breakdown video, which are the forecasts that I release every single day for the Diamond members. If you want to trade alongside myself and the members, join the Diamond membership, where you will have access to the 38-page supply and demand zone PDF, which will be your complete trading guide, the daily market breakdown videos, which are forecasts that I release every single night for the members to trade alongside myself, step-by-step video lessons A to Z, covering everything you need to know on supply and demand trading, the Sunday strategy Zoom session, where members submit homework, and it's an interactive 1-hour call where we go over all of your homework and every trading related question, private access to myself inside of our private Discord group where I answer all of your trading related questions, and finally the Sunday live stream forecast where we break down over 30 markets together. And it's not just me. Here are some of the members and some of their trades they've been taking lately, absolutely killing it. And we also have some amazing reviews from some of the past members sharing their experience within the group. So if you're ready to trade alongside myself and the community, join the Diamond membership today. Links in the description down below. All right, now we are going to move on to trading time frame sequences. Which time frame should you trade this methodology on? Now, if there was one comment I get every single week on my YouTube channel, and I am not lying, it's almost once a week I get this comment, Kevin, which time frame should I be trading on? And I tell everybody the exact same answer. There is no best time frame. That does not exist. It all depends on what your personal life looks like. Now, I will admit, a 1-minute entry, a 5-minute entry, those time frames, look, there can be a lot of noise on those time frames, whether, Trump tweets this and says that, or whatever goes on in the news, especially as of late. Yes, the 1 minute time frame, even the 5 minute time frame for entries, I personally think you will be stopped out a little bit more based on the fact that we will see more noise. But in general, as I have written down here, price is fractal. You can see on the screen right now, this is a 1 minute time frame and this is a 1 month time frame. You almost couldn't tell the difference if I did not have it labeled 1 month or labeled 1 minute, or you couldn't see the chart up here. You wouldn't even, if I asked you which one's the 1 minute and which one's the 1 month, you wouldn't even really be able to tell. I mean, maybe on certain 1 minute time frames you could see some whippy price action, fair enough, but in general, generally speaking, price is fractal. So we cannot even tell the difference between which time frame. So it's not like price behaves differently on like a daily time frame compared to an H1. Again, except for the fact that on the 1 minute and the 5 minute, we will see a little bit more, spikes and stuff like that. And then even when we have economic data coming out, or FOMC or anything like that, yes, we will see more spikes with big wicks like that, where over on a daily chart or a 1 month chart, that wick might not be as noticeable. But obviously we can get wicks on a daily chart as well. So it is fractal for the most part, but again, 1 minute, 5 minute entry, it can be a little bit more difficult. So you will get stopped out and spiked out just a little bit more. However, on a 1 minute entry and a 5 minute entry, you're going to get more trades than if you were swing trading on an H1. So it almost always evens out. The pros and cons are almost always even for whatever time frame you are trading. So it really all depends on what your personal life looks like. Are you working during the day? Okay, if you're working during the day, then maybe swing trading is for you. If you're working during the day, let's say you have a job where you're at an office, or a really popular thing now is everybody's working from home. On their personal computer. I have many friends who are now working from home on their computer. I have a friend who works from home and he actually plays poker on the side very profitably while working from home. It's pretty awesome. So that could be one thing you could do as well. Just make sure your boss doesn't see. Even if you have a day job where you're in the office, and you might be able to take 5 minute entries, right? You might be able to just check your chart every 30 minutes, see if you have a zone, and maybe take the trade. But I understand that a lot of jobs, you won't be able to check the charts every, 20, 30 minutes in order to take day trades. And not only that, if you're working at a job and then you're trying to please other people, please your boss, and then you're also looking for trades like on a 1 minute or 5 minute chart and then stressing out, that's going to lead to a lot of stress, in my opinion. That's not something I would ever do. And that's only going to lead to poor decisions, poor trading decisions. You never want to add more stress to your trading, or else you're just going to make bad decisions. I promise you, I have been there. So if you work a full-time job, or if you just can't check the charts all day for whatever reason, everybody has their reasons, I would definitely stick to swing trading. Me personally, I enter on the H1 and the H4. Very, like, the odd time I will enter on a daily chart if it's making sense with my 1 month, I will, but typically I am entering on the H1 and the H4. Now, obviously with the H1, I get more setups than with the H4, just because, I don't even know if I have to explain that. Everybody should understand that. But it is important that we are also using our higher time frame. And again, so let's say you are entering on a 50-minute time frame, our 4-hour chart is going to be our higher time frame. So if we just go back here, you can see this example here, we have our higher time frame and our entry time frame. So this could be our 4-hour time frame, higher time frame, and then we come over here and we're on a 15-minute time frame looking for our trade. This could be a 15-minute higher time frame and a 1 minute entry. This could literally be a 1 month higher time frame and a daily entry. This could be an H1 higher time frame and a 5 minute entry. It does not matter. It really all depends, again, on what your personal situation is. It's really that simple. Again, if you can check the charts all day, maybe you can add some day trading in. And what I really recommend for new traders is to always, if you're going to start to trade, I would trade on a demo account first, so you understand how to actually place the orders. Then after, after a week, Then I would fund an account, very, very small amount, and I would risk like 0.25% just as you first get started. And I wouldn't mind day trading if you can. The reason is because you're going to get more setups, you're going to get more experience in the market, and that more experience is going to lead to better psychology, which is extremely important. So at first, I don't mind you guys, looking for 5-minute entries, 15-minute entries, just to get more experience. But again, we're risking 0.25%. The goal is not to make money. The goal is to come up with a strategy and build your trading psychology up. Me personally, that is what I did. And then I moved over to swing trading, entering on the H1 and the H4. You might notice that I also said I enter on both, and that is definitely not something that I recommend to newer traders. If you are just getting into supply and demand trading and you're just getting into multiple time frame analysis, I recommend sticking to one sequence. Pick your sequence based off of your lifestyle and stick to that. I don't care. Let's say you pick the H1 entry and the daily and the higher time frame is the daily. I personally think that's a great middle ground. You're going to get a couple setups a week compared to like a day trading, right? Maybe you get it twice as that. But you're going to get a couple setups where the H4, there's going to be weeks where you might not even get a setup. And that's just the reality. That's why I, as an experienced trader, I've been doing this for 6 years now. I like to trade both. So, and by the way, if you guys want to watch my forecast weekly and follow along with my supply and demand analysis every single week, make sure you subscribe. Like the video so far if you're liking it so far, and subscribe for my forecast every single week so you can follow along and see the accuracy of this with proven results that are on video, not just some fake P&L and all that crap that everyone else does. So I stick to I trade both, but again, I would stick to one time frame. Let's say you pick the H1 in the daily. You're like, Kevin, that's a great middle ground. That's what I like. I don't care if you see the best H4 entry or the best daily entry or the best 5-minute entry. Do not trade it because that will only lead to confusion. I want you guys sticking to one time frame sequence until you are profitable for at least 6 months. That's what I recommend. That's what I did myself. And now I have the ability to not get confused and use the H1, the daily, the H4, and the weekly all together to make my trading decisions. But again, I cannot stress enough, stick to one time frame sequence as it's going to just lead to less stress, less confusion, which should lead to better results. Now we are going to go through step by step how to trade confirmation using multiple time frame analysis. So you can use this literally as your exact guide. You can use this PDF if you want. And by the way, this PDF will be available for all Diamond members upon joining, as well as my full course supply and demand PDF as well. That's over 38 pages. So you can use both of those as kind of your trading guide every single day. Should definitely help. So it'll be available for all of the Diamond members. So step 1. Follow these steps when you open your chart. Hopefully, your chart's blank. I would make your chart completely blank and I would go to, your chart should look like this. It should be, this is the last candle that closed, and then you're looking to the left for your supply and your demand zones. So step number 1, on a blank chart, map out your higher time frame zones. And a lot of members like to use my higher time frame zones and then trade their strategy inside of them, because part of the group as well is you will get all of my zones. So a lot of people wait for my higher time frame zones to be hit, and then maybe they trade some other strategy inside of the higher time frame zone. So that's something that the members like to do. For this example on the chart, this is an H1 chart and a H1 higher time frame, and this is supposed to say a 5-minute entry time frame. Or well, this is an H1 as well. Sorry. So HTF equals higher time frame. ETF equals entry time frame. That is the acronym. So the first thing we do is, you can see over here, blank chart, but immediately you can see my magnifying glass is magnified on this area because I immediately notice this explosive move away. That is the first thing you should be looking for when you open up a chart. You can see explosive move away, removed an opposing supply zone, leaving us with our higher time frame area of demand. So looking at a real price chart, I found a pretty good example over here. This is an Aussie US dollar 15-minute time frame. This is a great example. I know that price ended up blasting through, but as you can see, we had this higher time frame opposing supply removed by this area of demand. So supply was removed by this demand zone. This is step 1. That was our blank chart, and we are simply drawing our zones. Now, obviously, this happened over here, and I'm doing that for the sake of the example, but if we were to go over here right now, immediately my eyes are going to this fresh area of demand right here, and I just don't really see anything of quality for supply. So if this was a real chart, this is exactly how I would approach this. I would draw this very clean and obvious area of demand, and we're simply just waiting for the pullback down to this demand zone. But obviously for the example, we already had this set up back over here. So we mapped out our higher time frame zone, right, by removing supply, and we simply mapped it out. What do we do from here? Well, this is what I like to do. I like to, which is step-by-step, number 2 is set alerts. It's not necessary, but in my opinion, it's actually very, very important. I like to place my alert just before the higher time frame zone. The reason I like to do just before is because I like to pre-plan. So let's say my higher time frame zone's down here and price is here. I want to start to map out the supply zones or the downward trend line before we actually contact the zone, just to prepare. It's not necessary. It's simply just to prepare, and so that I'm not doing things like last minute kind of thing. So I place my alert right before the higher time frame zone to prepare to look for our entry time frame trades. You can see here our higher time frame zone, and this red line represents our alert. That's not actually what an alert line looks like, but I'm just doing that for the sake of the video. You can see we create an alert over here on the gold chart simply when it's crossing the price that we set it at. And what I like to do, it's really simple, is we simply just right click and you can add an alert right there. So let's say I right click up here. That means my alert is going to be placed up there. You can see, I don't know if you can see the red line. There's my alert. I can even just move it down if I wanted to right there. So what this does is it allows you to live your life. Everybody trades so that, I like to trade so I can go golfing during the weekend with my buddies, or hang out with my friends, or hang out with my family, right? So, I don't want to be looking at a chart all day long. And by simply using alerts, it makes life so much easier. You're just going about your day, you're on the 9th hole, whatever, you're hanging out with your family, price takes off, you never get alerted, right? Or price hits your alert, then all of a sudden you have potential trading opportunities that day. And all it does is it just makes, it's more of a routine, right? You wake up in the morning, you find your higher time frame zones, set your alerts, and go on with your day. Maybe you're at home all day, you set your alerts, and then you go out. I like to work on my lawn a lot, and I like to spend time outside. So I like to go outside. If I get alerted, perfect. I'll go downstairs in my office there, and I'll start to look for trades once my alert is set. It just makes life so much easier, and all part of trading is just making everything easy and seamless. So that's what I like to do. Simply just place an alert. Makes life so much easier, and in my opinion, it takes out emotions and randomness out of your trading. Step 3, when trading a multiple time frame analysis, after your alerts have been set, we need to be patient. Yes, that is actually a step. The third step is to practice patience. Now, I touched on it earlier. My podcast aims to help traders with that part of the trading, the psychology aspect. And if you are struggling with patience, I cannot recommend this podcast enough. I get so many. I did this just for fun. I was just bored, and people said, "Oh, when's the next podcast? When's the next podcast?" So it's something I'm trying to do more. And again, it aims to help you with your psychology aspect, because in my opinion, if you don't have, I could literally give you guys profitable trading signals. And if you don't have the ability to hold from here to here, you're not going to make it. And that's a part of psychology that we really need to master. And that's only going to come with time. And that's why I try to speed up that time by making the podcast. So we are going to practice patience, guys. We need price to actually touch our higher time frame zone. You can see with this example down here, price came down, almost contacted the zone there. You can see there's space between here and the actual zone. You can see our red alert. This is our red alert right there. And then you can see price. We did get a nice little rally, but I called this is what I like to call a false move before the zone. So you might have gotten a little confirmation trade in here. You might have made a little bit of money. But if you're looking for like a 5-to-1 trade, you would have got screwed there. Why? Because you were not patient and you did not let your actual higher time frame zone be hit, right? You can see false move, and then all of a sudden, boom, our higher time frame alert was triggered. Now we are looking for trades. That's why I also like alerts, because I might have seen this and be like, oh, it's close enough, I'm going to take a trade. I might have taken a loss, where if I just set my alert at the zone or just a little bit before the zone, then this would have prevented me from trading this false move, and I would have had my higher time frame alert triggered. Then we're looking for trades, and look at the move we got after that. So again, patience is so important. We don't want to get caught in these false moves. Now, let's say, again, I brought it up earlier, let's say it's like super close like that. It's not actually touching, but it's like so close. Okay, at that point, I think it's fair. Again, it's all going to be a judgment. I don't have a measuring. I don't have a certain amount of pips to determine that. It's really... It is a visual thing here. That's just too far away from me. That's why we got a false move, and then we got the real move later. Then our higher time frame was contacted. So again, we want to be very, very cautious of these false moves and wait for our zone to be actually contacted. And the final step 4, is once our higher time frame and everything has been hit, and we know it's been hit for sure, then we look for confirmation on our entry time frame. You can see the bright blue for these examples down here, that represents our higher time frame, and then the light green is our entry time frame zone. So we are looking for confirmation on our ETF. We first pick the type of confirmation entry we would like to take. As I mentioned earlier, I always prefer the pullback entry, that stop breakout order that I talk about. I really only use that sometimes when trading the S&P 500, or when I'm just looking for my long-term buys. When I see an opposing supply level, I want to trade the breakout of that with no stop loss because it's a long-term investment. But when you have a stop loss, that's when your risk reward can be flawed with that breakout order. That's why I always prefer the pullback entry. So we need to map out the opposing zone, trend line, or the structure you want to see removed. Again, going back to the 3 types of confirmation, we have a zone removal, right? So down here in confirmation 2, you can see supply zone removed, right? We can see beautiful supply zone right here, the basing, strong move away. That supply was removed by this demand, and that is our confirmation. So as we are on our entry time frame, before any of this happens, we are just simply, as after our higher time frame alert was triggered, now we go and we draw our supply zones, or we draw our downward trend line, or we draw our structure high. Or in this example, we literally have all 3. We had a downward trend line coming in here. I don't have it here, but this is the same example, just 3 different types of confirmation. We had our downward trend line removed, we had our supply removed, and we even had an obvious structure high removed as well. So this was like a big 3. This was a triple whammy, guys, okay? So this is a big 3 confirmation, and then once it's removed, literally all we do is we take our limit order, right? We are placing a limit order at the zone with a stop loss below and a take profit above. People ask, where do I put my stop loss? Look, I like to just enter pretty much at the zone a little bit before and my stop loss comfortably below. If the zone looks weird, as in there's a lot of weird basing candles, this is not a great example. This is a very, very clean zone where you could easily have a stop loss just tight underneath to maximize your risk reward. Then at that point, if the basing's weird, you can have a wider stop justifying it. I think that's reasonable. And again, you could just have a wider stop loss anytime. Remember, there's only pros and cons. There's no right or wrong. If your stop is wider, your take profit will be less. You will have a worse risk to reward. You'll be less likely to be stopped out. If your entry is really tight with a tight stop loss, you might miss your entry, or even if you might get stopped out more. However, your risk to reward will also be greater. So there's pros and cons to everything. There's really not right or wrong. And I want you guys to get that through your head. Please, if there's one thing you can take away from this video, there's no real right or wrongs. There's only pros and cons, which we will be talking about soon. So again, our higher time frame, go through the steps again. Higher time frame alert was triggered right here. Higher time frame demand and control, boom. Right away, we're drawing our opposing supply and our downward trend lines and our opposing structure high. And then we want to wait for that to be removed. We place our limit order and we just let the trade play out. It's really that straightforward. The hardest part is identifying the opposing zones and the zones that we want to be trading. Now on to one of my favorite parts, is slapping you guys into reality. I'm sure a lot of you guys have watched this. Wow, this is going to be the key to my trading. This is going to solve everything. And yeah, of course, the whole point of this video is to showcase to you guys the power of confirmation, and it can definitely give you some sort of edge in the market. But don't act like, oh wow, this is going to completely stop me from losing trades. It is simply not, and that is why this slide is very, very important. I'm just simply going to pretty much read it here. So many of you think that just waiting for confirmation will prevent you from losses, which is definitely true. However, waiting for confirmation will also make you miss trading setups. There are pros and cons you're going to have to accept as a trader. It does not matter if it's confirmation or whatever. There's always going to be pros and cons. You have to be completely fine with waiting for price to hit your higher time frame. A lot of people do not have that patience. In my opinion, people's lack of patience is the reason that they fail at trading. It's a huge reason. They see all of these quote unquote trading gurus on YouTube talking about $50 into $5,000 in one day trading, which is a blatant lie. Unless you got super lucky with Bitcoin or something, that's not even really possible to get that big of a return in a day, and let alone a year. So if you don't have patience, you're just simply, it's not going to work. So you need to be completely fine waiting for your higher time frame zone to be hit, waiting for confirmation only to not get it. So going to a real chart over here, what can happen? So going to this chart, like you could see a good demand zone here, and price may not ever get a pullback, right? Price may pull back and you might not get your confirmation, and price takes off without you. And if you would have just taken this zone, right? Let's say you would have just taken the zone, boom, something like this, stop loss nice and below, decent tight entry, targeted the high. You just missed out on an over 2-to-1 trade, almost a 3-to-1 supply and demand zone trade. But instead, you look for confirmation and you didn't get it. So you missed out on that trade. And that sucks. But again, it's all part of reality, because again, you could have said, I'm not waiting for confirmation. I'm not gonna miss out on this trade. And price could have blasted through your zone, where if you looked for confirmation, you might have got the confirmation trade, or you might not have gotten confirmation, and then price blast through your zone and you prevented a loss. Hopefully you're already starting to see both sides of the equation here. You have to be completely fine with waiting literally 3 days for your higher time frame zone to be hit, and just simply not getting the confirmation. If you don't have that patience, and then when price hits your zone, you don't even get it after waiting 3 days. If you can't deal with that, you really got to work on your trading psychology. So you also have to be fine with waiting for confirmation, getting entry time frame zone, but never getting the pullback, right? So going back again to this chart, you guys know we did get that pullback. So going back to our entry time frame here on the 1 minute time frame. Actually, this is a great example. So price came down, right? We contacted our higher time frame zone, this big green zone here. This is a fantastic example. Basically, what happened is we had our opposing supply removed right there, and then we had our confirmation zone down below. It's literally almost a picture perfect type of confirmation. Why is this confirmation? Again, because we removed our supply, we have our basing, and then aggressive move away. You can see price came all the way down, took off without us, and we did not get involved in the trade. And then when price came back in over here, this was a losing trade. But I would have not have taken this confirmation, as price just took too long to pull back into it. And then at that point, our higher time frame, we already got the move on our higher time frame. So this would be a no trade. So that's just a little extra bonus tip for you guys. We want to get a pretty quick pullback to the zone when looking for confirmation, because at this point, we got the move from here to here. The move on the higher time frame already took place. So buying a pullback here, very, very aggressive, very, very aggressive. The only way I would ever really trade that is if we could have proved that there's liquidity here by getting a nice reaction off of the zone. Then I would consider taking that trade with aggressive trade management. If you don't know what I'm talking about with liquidity, check out some of my other YouTube videos. I have a few videos on liquidity. It's definitely a huge part of my trading. So definitely you want to check that out. I'm not going to talk about it here. So you have to be completely fine with, again, going to our higher time frame. This is a 15-minute chart, but let's just say this is a daily time frame. You had to wait the zone wasn't created till here. You had to wait 1, 2, 3, 4, 5, 5 days for price to come into our zone, right? And let's say the 1 minute, let's say it's our H1. Again, I'm just making it up just to show you the difference here. Then you had to wait for this zone to be hit, right? So then it took 1, 2, 3, 4, 5, 6, 7, 8, 9 hours, almost got the pullback, and it takes off without us. So you basically waited 3 days, got the confirmation zone, and you didn't even get a trade. And that is going to happen, and that is all part of trading. And that is something that you need to accept. And this one hurts a lot, as again right here. This hurts a lot. This has happened so many times to me. I mean, where I'm like looking on gold and I'm waiting for a good higher time frame zone. This is like years ago. Gold's been on an absolute tear lately, but waiting for a nice trade off this higher time frame zone in oil or whatever, or euro, whatever. And then you get your confirmation zone and price never pulls back to it and it takes off without you. It really stings, but remember, take everything as a lesson, guys. Everything as a lesson, everything as a test. That's how I view it. That's how I view everything in my life, and my life has changed drastically. Everything that happens to me, I literally just view it as a test. I'm kind of a religious person now, and I just view everything as, okay, God's testing me. And whether you're religious or not, that's fine. It does not matter. That's just how I view things, and that's how I would personally view this one as well. If that happens to you, remember, that's just God, whatever you want to view, it does not matter to me. I'm not trying to get religious here at all. Just view it as, okay, I am being tested. My psychology, my personality, just myself, I am being tested right now, and that's going to separate the men from the boys here, or the women from the girls, whatever you want to say. If you can deal with that, you can pretty much deal with anything. And this one really, really stings, especially if you're waiting 2-3 days for price to really pull back. You also have to be fine with getting confirmation on an entry time frame. Price pulls back to your confirmation zones and then hits your stop loss, only to go in the direction where you already were. So again, going back to a real chart example here. Let's say price came down, we hit our zone, we're in the trade, looking good, then all of a sudden, I don't know, the orange man, Mr. Trump, says something bad on Twitter or whatever he's on now, and boom, this spiked down with a wick, stopped out, and then we get the move in our direction. That one really hurts. This is probably the worst one, especially again after waiting 3 days, and then this happens. It's like, oh my, like, trust me, it makes me want to punch my computer, it makes me want to throw my mouse, it makes me want to do all of that, but there's nothing we can do, and we simply have to just be stoic about it and move on. There's no need to cry. There's nothing you can do. You can't take the loss away. For example, I used to play hockey. I mean, I still play hockey, but back when I was playing competitive hockey, the refs, I would get a penalty. I disagreed with the penalty, and often I would argue with the refs, swearing at them. And I learned my lesson pretty quick, because you get an extra penalty for it. And then I remember my dad telling me, he's not going to take the penalty back. He could literally admit that it wasn't a penalty, and he can't even take it back anyways. So there's literally no point in arguing with the ref, and there's no point in worrying about this if that does take place. Now, let's say price does this often, where it just stops you out. Let's say that happens often. Then in your trading journal, hopefully you're journaling your trades, maybe you just need to move your stop a little bit more. But that's a difference between just unluckily getting stopped out like that and spiked out before price pushes up. So that's something you will have to deal with, and that's something that's going to happen. And again, just view it as a test, and life becomes easier when you view everything as a test. So there's a balance to everything, right? The next slide, we're going to be going over pros and cons. So this actually should have been on the next slide, but it is what it is. I'm going to read this here. As in life, there's a balance to everything. There's no such thing as a free lunch. That does not exist. There are pros and cons to literally everything. Everything in life, trading, whatever. If you switch from regular pop to diet, which is something I actually did recently, like just because I'm trying to limit my calories a little bit, just having a pop having a pop isn't really the best thing for you anyways, but I'm like, you know what, I'm going to enjoy a pop with dinner every now and then. I'm just going to not have that sugar and those extra calories. But I am smart enough to know now that, yeah, sure, I don't get the sugar or the calories. Instead, I'm getting the aspartame, which is carcinogenic, which some people say it's not. I don't know. From my understanding, it probably is. I mean, again, going back to the core concept that there's no free lunch, it's not a free lunch. I mean, I have a buddy that calls Diet Pop, like Diet Coke, he calls it a cheat code. I think it's kind of a funny concept. It's a cheat code because you're not getting your sugar or calories, but really you're getting the aspartame, which apparently is not too good for you. So that's, again, there's pros and cons. Yeah, you're not getting the sugar. you're getting the other stuff instead. If you buy cheap clothes, it's cheaper, but it doesn't last as long. Me personally, I only really wear white t-shirts. If you ever meet me, which I mean, I never show my face or anything about me really. I only wear white t-shirts. Yes, I have other shirts, but if you were to catch me anywhere, it's literally 99% chance I am wearing a plain white t-shirt. When it's my white t-shirt, I buy cheap ones because I'm constantly spilling on it and they're just cheap. But however, if you're buying nice clothes, like a nice suit or a nice sweater, if you buy cheap clothes, yeah, it's cheaper, but it might not last as long. I have great examples of some cheap sweaters that I bought and they were cheaper, like half the price. However, like the cuffs around the wrists, it just seems like it's just disintegrating. And that's the reality. I paid a cheaper price and that's what I get. Fast food. Fast food is quicker. There are no dishes, right? I love when you get fast food or there's no dishes. It's great. But it costs more and it's less healthy than cooking at home. What I'm trying to do here is just show you that any decision you make, whether you want to look for confirmation or not, whether you want to look for confirmation or set and forget trading, there's pros and cons to them, just like waiting for confirmation. There's pros and cons to everything, and there's pros and cons to waiting for confirmation as well. These are the pros and cons. The pros of trading confirmation are one, it can prevent losses. Price could absolutely spike through your zone, prevent a loss. Number two, it can narrow down your entry and get a bigger risk to reward. So again, going back to this great example over here. Let's just say for the sake of it, let's just say this trade triggered. Let's make a fake wick here just for the sake of the video. And we wicked into the zone like this. It actually looks legit. Remember, this green zone here is our higher time frame. Let's say you're targeting that peak over here. Let's just say this is our target. So let me just make a bigger point right there. If you were to take the entire higher time frame zone like this, it's not a bad risk to reward. It's a 2.5 to 1. Now, let's say you waited for confirmation. Decently wide stop loss, decent entry. That same target is now a 9 to 1. Let's be safe. Let's cut that in half because I like to keep things realistic. A 5 to 1 trade. So that's the difference. Let's say both trades worked out. You made a 2.5 to 1 and then a 5 to 1. But obviously, again, going back, there's pros and cons. It's not always going to work out like that. So when looking for confirmation, we can narrow down our entry and get a much larger risk to reward. But obviously, that makes it more likely to be stopped out. Confirmation trading means that you are trading with your higher time frame zone, which will increase the odds of the trade working out. Obviously, a demand zone within a demand zone within a demand zone is going to be pretty strong. But if you're trading a demand zone within a higher time frame supply zone, might not be the best situation. So when you're trading confirmation, we're trading with our higher time frame, which is always going to increase the odds of our trade working out. It can give you more confidence in your setup, right? By seeing, we talked about it earlier, by seeing price shift to the side that you want to trade with, that definitely gives confidence. But again, we still need to be patient. We don't want to just jump the gun. We need to be patient and wait for the pullback. And then sometimes it's easier on emotions, especially when price blasts through your higher time frame zone. It is almost easier to have our higher time frame zone not get the confirmation. That sucks. But those emotions, those negative emotions are way easier to deal with than if price just comes back and blasts through your zone and you're out of the trade within 2 seconds. I mean, this year with Trump, there was a couple trades where like I was in and out in like a second because of what Trump did. And that's as a swing trader, which is actually crazy. So, and I moved on. I actually, you can go back and watch some of my videos. I made up for that pretty quick, but that's only because my trading psychology is top notch in my opinion. So again, it's easier to, the emotions are almost easier to deal with if you don't get confirmation than if price just absolutely blasts you out of the zone within 2 seconds. Trust me, I've been there. Now moving on to the cons, because not everything is a breeze. Sometimes you will miss your entry, where if you just traded your higher time frame zone, you would be in the trade, right? We've already talked about that. That does suck, but that's definitely a con. Another con is it's more time consuming, right? I could open my chart. I'm going golfing that day. I have a 1 hour zone. I simply place my order and I let the trade play out. Where if you're waiting for that 1 hour zone to be hit, now your alerts get set. Now you're looking for confirmation. And now you actually have to be on the charts and waiting for confirmation to map out your higher time frame zones. It's more time consuming. But again, yes, it's more time consuming, but it can prevent you from losses. Notice how whenever you say something over here, you automatically have to go over here. Whenever you say a con, you actually have to go to the pros, right? It's just funny how they work hand in hand. So yeah, it's more time consuming. You have to pay attention to the charts more than set and forget trades, that's for sure. And this is definitely harder when working a full-time job, definitely. And then if you are using a breakout stop order entry, your risk reward will typically be worse. And that's only if you're doing that. This was just something I added in. If you're doing that, your risk reward will be worse if you're doing that stop entry. But again, so your risk reward will be worse, but you're going to get more trades. So there's pros and cons, the yin and yang. Last but not least, it can be very frustrating, again, when price is inside our higher time frame and you don't get any confirmation. If you're a day trader, if your higher time frame is like a 15-minute and a 1-minute entry, this isn't really going to be as frustrating because you're going to get a pullback to your 15-minute time frame within like an hour sometimes. Where if you're trading the daily and the H1, right? That's a while. That's a while. It could be like a week until price pulls back into your zone, and then you might not even get the confirmation. So it's more frustrating as swing traders. But remember, there's pros and cons. Always refer to this PDF to understand the pros and cons and to help slap you guys back into reality. But that is going to wrap it up for the course, everybody. I hope you all enjoyed it. If you did, please leave a like and subscribe so you can catch more of my videos and my weekly forecast videos. And if you have not watched my full course on YouTube yet, or even if you have and you want to get back to the basics here and just kind of, just get everything into your head and just make sure you understand it, make sure you go watch my full course now. And if you want my charts, daily market breakdown videos, everything included in the membership, check out the Diamond membership where you get access to this PDF, my other full course PDF, and basically my daily market breakdown videos where I'm forecasting the market every single day, guys. It's very important, and it can just help you see what the zones are, and it'll definitely help you in your trading. I'll see everybody in the next video.